Okay. Welcome, everybody. Welcome back to another exciting show for you. We are here in the studio, if you will, and we are live. We are ready to make this happen. So, just making sure everything is online, up and running. Okay, we're ready to go. Let's not delay any further. CryptoDeposit.org. We are the live stream Money in the Music, if you will, Money in the Music. And if you don't know what this is all about, the answer is we are discussing recent blockchain news, stablecoins specifically. That's in my opinion, the key focus for the industry. Digital assets overall. Regulations, because every country's got different jurisdiction, and then other interesting news. And on today's agenda, we have 4 different articles that are teed up. So let's jump in with the first article and maybe offer a little bit of commentary. All right, so let's do that. Let's press the button here to change screens, and then we will be going into the details, if you will. Okay, and a reminder here: these shows, everything is really brought to you by ourselves. We are CryptoDeposit.org, so focused on fixed income, focused on stables. So if you go to CryptoDeposit.org, my friends, you're going to find out there's a bunch of options: deposit cash, buy stables, deposit stables, review your holdings, borrow and lending, over-the-counter OTC, view your statements, and then of course you can have the message function, activities, the exchange itself, swap, and at the bottom of the page, review our white paper. We have a YouTube video on that, verification, and then refer, press, terms of service, whole bunch of great. So let's get into article number 1 on today's agenda, and let's make sure that the text and the font is a good size so people can see it. So let's see if this is showing up okay on the screen. Hopefully the visuals is okay. Let's see over here. How does that look? Okay, it looks okay. Seems to be looking okay. Vitalik Buterin proposes options-based DeFi to replace liquidation-driven debt model. This article is from just yesterday, on the 3rd of June 2026. Ethereum co-founder Vitalik Buterin proposed splitting one Ethereum into 2 paired option assets that always sum back to 1 Ethereum. Eliminating forced liquidations and letting synthetics rely on slow prediction market-style oracles. All right. Ethereum co-founder Vitalik Buterin on Monday proposed rebuilding decentralized finance on options contracts instead of collateralized debt, a shift that would eliminate forced liquidations and let synthetic assets run on slow prediction market-style oracles rather than the real-time price feeds driving most of DeFi today. Interesting. Okay. Options contracts. The proposal, building index tracking assets on top of options instead of debt, published on the Ethereum research forum, defines 2 assets P and N with the strike price S and maturity date M.A parentheses P comma N. Pair is minted from 1 ETH, 1 Ethereum, and can be redeemed for 1 ETH at any time. At maturity, an oracle resolves index to X semicolon. P receives min 1 comma S divided by X Ethereum, and N receives maximum 0 comma 1 minus X divided by X Ethereum, because the 2 payoffs always sum to 1. There is no possibility of liquidation, Buterin wrote. The post credits feedback from Lighter founder Vladimir Novakovsky and developers of the Curve decentralized exchange. Okay, so there's feedback, as this is the equivalent of what they call peer review. So Vitalik went from computer programmer to quasi PhD in mathematics. So liquidation cascades have been DeFi's dominant failure mode for half a decade. On March 12, 2020, Ether fell roughly 43% in hours. MakerDAO Keeper bots failed to bid, and a single bot walked off with 8.32 million of Ethereum for 0 DAI. Wow. Maker took on a 6.65 million DAI shortfall and later paid 1.16 million to settle a class action from vault owners. Every CDP-based protocol since has been tuned to the assumption that bidders show up. Buterin's design removes the auction entirely. So, what the mechanism changes? The problem with relying on liquidations is that liquidations depend on real-time oracles, the post argues. You cannot use what is by far the most effective technique to make a safe and cheap oracle. Put a prediction market in front of a safe but expensive oracle and only use that oracle in the case of serious disagreement. Splitting one ETH into a P divided by N pair fixes that. The system is solvent by construction, so the oracle can resolve at maturity instead of every block. Buterin equates the design to scalar prediction markets on platforms like Seer, letting the instrument share oracle infrastructure with markets that have run for years. Okay, where options DeFi already exists. So the primitive is not net new. Panoptic runs perpetual oracle-free options on Ethereum mainnet by tokenizing Uniswap version 3 LP positions. Oppin's Squeeth wraps a power perp on ETH squared exposure. Premia operates an options AMM with portfolio margin. What Vitalik proposes sits one layer higher, a synthetic that tracks a price index by stacking options rather than borrowing against collateral. The user playbook is to hold deep in the money options and rotate them into lower strikes as the price gets close. Rebalancing could run through an automated DAO wrapper or through a local daemon. The latter, Buterin notes, reduces the user's MEV risk because the transaction is not visible ahead of time. The 2% tax. The cost is drift. Holders of P don't get a clean dollar peg. They get a quadratic deviation from their target exposure that grows with the gap between current price and strike price. So Buterin pegs the realistic range at standard deviation roughly 1 to 4% per year and reframes it as a feature. The design is unusable as an accounting stablecoin. A counterparty or tax authority won't treat 1p as $1, but works in the context of I want price stability, meaning pre-funding a known share of future expenses. The bigger competitive risk, Buterin warned, is rebalancing itself. It is very easy to lose 2% per year or more from multiple rounds of slippage, and this is the largest risk by which this whole scheme might become uncompetitive. His proposed mitigation exploits the fact that rebalancing users have very low time preference. They don't care whether they trade today or 3 days from now. To build an ideal market structure that minimizes slippage far more than traditional AMMs do. So the post is research grade rather than a deployment plan, and no protocol has yet committed to building on the spec. So this is pretty interesting stuff. You could basically say that Vitalik Buterin, excuse me, is the thing with Vitalik is that he really is a computer programmer, okay? And he was able to witness what happened in 2022 with Sam Bankman-Fried. And there are people that enter the space from the purely computer science and programming side. There are people that enter the space from the mathematical side. And then now you have what we're seeing here is the meeting of the minds of many, many years of what Ethereum has done in the world of DeFi and trying to solve the real problem that presents itself, as this article says, for more than half a decade. Okay, the problem is that there's, as this article notes, they want to rebuild decentralized finance on options contracts instead of collateralized debt. So a shift that would eliminate forced liquidations and let synthetic assets run on slow prediction market style oracles rather than the real-time price feeds driving most of DeFi today. Okay, so that would really initiate a big switch overall. So the entire shift of DeFi, would the Overton window would move, if you will. Now, this middle section here is really where the rubber hits the road, because this is the mathematical input that they're trying to solve. And the key here is there's no possibility of liquidation. So they're trying to solve the biggest problem of really being a buyer and a seller, or somehow they're being a sort of phantom buyer when there's really not, or a phantom seller, and there needs to be liquidations. So the marketplace is really priced in. There's not a lot of slippage, all of that good stuff. So, excuse me. So with that being said, I wanted to add this article to today's live stream because it's really a good balance of not just the specific example of what Vitalik Buterin is proposing, because Ethereum has been around really since 2014, but more specifically where he wants to go to keep Ethereum relevant, and how to reimagine Ethereum in most of DeFi. Okay, so I really enjoyed this article because it's a good balance of hypothetical and problem solving. It seems that the next step would be, after this quasi peer review, if there's going to be some sort of adoption or vote or implementation or that sort of thing. So let's see next steps for Ethereum, and good luck, because this might be a very big change in the industry. So now we are on to our second article of the live stream, as we cover a few articles today. Excuse me. So what is the article we are addressing here? This article is from Bitcoin Magazine. CME Group goes live with 24/7 crypto futures and options, launches Bitcoin volatility contract. So this is another article that I thought was good to basically bring into detail what's going on. So let me just change the font here so we know that we can have people see the article better. Whoops, let me just see if that works. Okay, that should be okay. So that should help your view a lot. So it says CME Group has launched 24/7 crypto futures and options trading on its CME Globex platform. Let's jump in. And this article is from the 1st of June. Okay, here we go. CME Group, the world's largest derivatives marketplace, has launched 24/7 trading for cryptocurrency futures and options, marking a structural shift in how regulated derivatives markets align with the nonstop nature of digital assets. Okay, so I think we should repeat this introduction sentence one more time because it sets the tone. CME Group, the world's largest derivatives marketplace, has launched 24/7 trading for cryptocurrency futures and options, marking a structural shift in how regulated derivatives markets align with the nonstop nature of digital assets. So trading went live at 4 p.m. Central Time on Friday, May 29th, on the exchange's CME Globex platform. Over the inaugural weekend, more than 7,200 crypto futures and options contracts changed hands, generating roughly $50 million in notional value. A figure CME said reflected demand from both retail and institutional participants, the CME Group release said. The move closes a gap that had long frustrated crypto traders. Under the previous schedule, CME's crypto derivatives halted on weekends, creating price discontinuities when spot markets moved and futures could not respond. Okay. Now, with a near continuous schedule and a 2-hour maintenance window each weekend, traders can react to market events at any hour. By offering continuous liquidity over the weekend, we are meeting client demand and bridging the gap between traditional regulated venues and the 24/7 nature of crypto assets, said Tim McCourt, global head of equities. FX and alternative products at CME Group. Since we introduced our first Bitcoin futures contracts in 2017, the ecosystem has evolved in so many ways. Yes, agreed. All right, so this, of course, is the X.com tweet. Sometimes you wonder if it's now branded X.com, why do they still call it tweets? Okay, so crypto derivatives volume over the years. The launch builds on record performance. CME records 3 trillion in notional crypto derivatives volume, recorded 3 trillion in notional crypto derivatives volume in 2025. And 2026 average daily volume has reached 407,200 contracts, a 46% increase year over year regarding average daily volume. So average daily open interest stands at 335,400 contracts, up 7% from the prior year. Support from key market participants underscored the breadth of the rollout. Robinhood Markets Vice President J.B. McKenzie said the launch marks the first time users can trade regulated futures contracts at any hour of any day. Ripple Prime President Noel Kimmel said his firm's futures clearing infrastructure was built to provide institutions with uninterrupted access to regulated crypto derivatives. Okay, well, we've been hearing about Ripple for quite a long time. So Ripple Prime President Noel Kimmel said his firm's futures clearing infrastructure was built to provide institutions with uninterrupted access to regulated crypto derivatives. Let's hope that's true. And then Wedbush Securities' Bob Fitzsimmons said his firm has served clients on a 24/7 basis for over a year and has developed technology to meet the demands of the new structure. Great. So CME's crypto suite now covers futures on Bitcoin and select other crypto. Wonderful. So CME's Bitcoin volatility futures, on the same day the 24/7 schedule went live, CME introduced Bitcoin volatility futures, ticker BVI, the first regulated product of its kind. The contracts settle against the CME CF Bitcoin Volatility Index, BVX, a 30-day implied volatility measure derived from real-time Bitcoin options order book data. So rather than taking a directional position on Bitcoin's price, traders can now go long or short on the intensity of expected price swings, a tool long available in equity markets through instruments like the VIX, but never before offered in regulated form for Bitcoin. And this is obviously something that people have heard about. The VIX, it really is something that people every day that are truly traders monitor the VIX. And that deals with equities and effectively fiat. So if you see up here, CME introduces the Bitcoin Volatility Futures, ticker BVI, the first regulated product of its kind. The contracts settle against the CME CF Bitcoin Volatility Index, so BVX, a 30-day implied volatility measure derived from real-time Bitcoin options order book data. Very, very exciting stuff, futures contracts. Now, I believe that the impact of this is going to be another step in the right direction, because you are adding another piece, another brick to an architecture of, for example, if you look at strategy, there's many other products that are being developed, which in and of themselves are building out the marketplace. So if the product is good, it will be adopted. If a product is faulty or not really able to deliver, it will not gain market acceptance. It will not gain market penetration and all of that. So it seems that for a lot of folks out there who have aligned investment theses, then they will believe in what has been laid out here, with this comparison between the VIX, which of course most people are familiar with, and now the unprecedented but now new precedent for BVI and BVX. So it would be good to see how this plays out in the weeks and months ahead, and we can check on that later down the line. Okay, so we are going to now go to our next article. I believe this one is from Decrypt. All right, so let's go to the next tab and see what's going on over here. Okay, so Kalshi eyes perpetual futures for XRP, Solana, Dogecoin, and these altcoins. So Kalshi moved swiftly to lock down an emerging market for perpetual futures in the US, filing to certify a slate of altcoin offerings. This is pretty interesting. And this article was also just from yesterday, the 2nd of June, 2026. So in brief, as Decrypt usually does, at the top of the article, they'll have some few bullet points to summarize, and then we can jump into the article. So it says in brief, wasting little time following the CFTC's landmark Bitcoin perps approval on Friday, meaning the end of last week, end of last month, Kalshi has formally applied to certify derivatives tied to 12 major altcoins. The CFTC indicated that perpetual futures would be approved on a case-by-case basis, so the tranche of derivatives wasn't immediately approved. Okay. Bitcoin anchors crypto's derivatives market at nearly 55 billion in open interest, followed by Ethereum, which is at 31.5 billion, Solana, which is at 5.5 billion, XRP 3 billion. There you go. So those are the top four for the crypto derivatives market, as it is overseen by the CFTC, not the SEC. Kalshi moved swiftly to lock down an emerging market for perpetual futures in the U.S. on Monday, meaning the 1st of June, filing to certify a menu of offerings tied to crypto's leading altcoins. So following the CFTC's approval of Bitcoin perpetual futures on Friday, the prediction market Kalshi has begun eyeing derivatives tied to Ethereum 1, XRP 2, Solana 3, Dogecoin 4, Stellar 5, Chainlink 6, Bitcoin Cash 7, Litecoin 8, Sway 9, Shiba Inu 10, Polkadot 11, and Hedera 12. Okay, so Polkadot, interesting choice. All the others seem to be also above average choices. So you have the link for the filing here if you wanted to see the specifics. So this, meaning this robust slate of products tied to digital assets, highlights Kalshi's deeper push. And they're noting here, amid fresh regulatory tailwinds into a space that's been historically dominated by offshore platforms like Binance and faces growing competition from decentralized upstarts such as Hyperliquid. Yes, and I believe we've covered Hyperliquid as recently as yesterday. So in its order on Friday, the CFTC indicated that a case-by-case process would be appropriate for U.S. companies eager to list perpetual futures beyond Bitcoin, noting that the class of derivatives overall design may not be suitable for all asset classes. That means Kalshi's tranche of derivative offerings hasn't actually been approved yet. Okay. Now, in terms of open interest, Bitcoin anchors crypto derivatives market according to Cointelegraph. The value of unsettled trades tied to the leading digital asset by market cap totaled 54.9 billion, followed by Ethereum's 31.5 billion, Solana's 5.5 billion, XRP's 3 billion. All right. Now, notably, Kalshi's derivatives wouldn't be off limits for customers in the U.S., a barrier that the CFTC symbolically cast aside when approving the firm's move on Friday. Meanwhile, the CME moved to make trading for Bitcoin futures and options a round-the-clock endeavor, as we just covered on the previous article. So, prediction market analyst Dustin Galker noted to Decrypt that Kalshi moved to self-certify the derivatives under a similar process to how it established offerings based on events. The altcoin slate hit the CFT's desk alongside markets tied to NFL athletes' performances. Okay, and the article is finishing up here with these last few paragraphs, so let's see here what they're trying to conclude. Although the CFTC's order on Friday was narrow in scope, some have described the development as potentially far-reaching, including strategy co-founder and executive chairman Michael Saylor. What are they trying to say by that? Okay, enabling regulated access to perpetual futures is good for BTC holders and supports the Bitcoin buying firm's flagship preferred stock, he said in an ex post. Okay, so Michael Saylor is in approval of the CFTC's order on Friday, even though it was narrow in scope. So perpetual futures, or perps, have long been popular among crypto traders. Unlike traditional futures, the derivatives don't feature an expiration date, allowing traders to speculate indefinitely amid periodic payments that keep prices anchored to underlying assets. The CFTC appears committed to making perps work in the U.S., even if its case-by-case approach reflects caution. In an ex post on Friday, CFTC Chair Mike Selig declared that the agency would use the tools at its disposal to onshore crypto assets perpetuals. Okay, and there you go. There you go, my friends. The CFTC has been very, very crypto friendly, digital asset friendly, and it seems from the regulation side that just overall, if you look at whether, certainly with this administration starting in January of 2025 till now, it's been a very pro-crypto administration. So I know that there's been a lot of people trying to really determine where do you draw the line between SEC and CFTC. What is a security? What is a commodity? Okay. But by having futures contracts be within the jurisdiction of the CFTC, and now, of course, perpetual futures in crypto. So Mike Selig and the CFTC, this is fully within their dominion, fully within their jurisdiction, and they're really being proactive. So and as you see here, what they noted a little bit up here in this article, up here, they wanted to make it onshore. Okay, so as you see, they don't want these activities to be moving offshore, such as with Binance, such as with, as it noted up here, Hyperliquid. So offshore platforms. In other words, there might be a way to build jobs, maybe even tax, but the regulation in and of itself, because of course we know Binance has had a lot of domicile questions over the years, fines, CZ being housed in Club Fed for 4 months. So anything that is firmly within U.S. jurisdiction is going to allow regulators to set the standard. So this is really proactive. In other words, when you say that the best defense is a good offense, this is the U.S. government and the specific agencies such as the CFTC playing very powerful offense, very proactive offense, very, very proactive. Now, with that being said, excellent article. Just letting you guys know that this is really the nexus point between markets, how they move, and regulation. So this is really some interesting stuff for those of us who really enjoy this, because this is sort of that push and pull between what the market wants, what the market's showing, what the market is pricing in, these trends, and then seeing the effective reaction, or in this case, the very proactive anticipation of these moves, and then moving as fast as possible within just a few days to claim it, define it, shape it, all that good stuff. So for people that are critical of government that's lackadaisical, this would certainly not be an example of being able to point the finger and say that a U.S. agency regarding markets, commodities, is not being extremely proactive. So you have to essentially give credit where credit is due. Let us move on to the fourth and final article that I have marked for today. This one is Cointelegraph. So let's just click on that link now. Oh yes, okay. This is the article that I really, really wanted to jump into, because for me, as I just noted, when you're talking about regulation, when you're talking about getting some clarity, here you are, the Clarity Act. Okay, so I really, really enjoy this key debate. So let me just try to see if I can move this over a bit so we can get a little bit better visual on the article itself. So hopefully that's a little bit more clear. Let's see over here. Just want to make sure that we can see the article as best we can as we shift that over. Okay, so I think I'm just going to move this just a little bit more over, and then we're good to go. So debate on Clarity Act continues this week as U.S. Senate returns. Okay, well, good to see that they are getting back to their jobs, taxpayer-funded jobs. So many Democrat lawmakers have said they will not support any version of a crypto market structure bill without provisions on ethics to address potential conflicts of interest by elected officials. Okay, well, that's very interesting to see, because when it comes to equities, I know that there's just immense amount of reporting on members of Congress and trading stocks. So ethics, provisions on ethics to address potential conflicts of interest by elected officials. Okay, fair enough. We'll take what we can get. Now, U.S. Senate consideration of the Digital Asset Clarity Act is likely to resume as members reconvene this week after an extended Memorial Day holiday. All right, great. Many U.S. lawmakers and crypto industry leaders are pushing for consideration of the Clarity Act, a crypto market structure bill introduced by the Republicans and passed by the House of Representatives in July of 2025. Okay, so that means that this bill has been sitting in Congress, passed by the other chamber, the lower chamber, the House of Representatives, 11 months ago. And now it is June of 2026, and the Senate is maybe finally considering it. The bill, expected to give more authority to the federal commodities regulator over digital assets, passed two crucial committees before the 1 week break. Well, that's a good sign. Before the Memorial Day break. It has been debated in Congress amid pushback from industry and banking representatives over stablecoins, tokenized equities, and other issues. Exactly. Now, this will be actually the biggest financial regulatory bill that Congress has done in quite some time, certainly since Dodd-Frank. Coinbase Chief Policy Officer Faryar Shirzad said in a Monday Fox Business interview, referring to a 2010 law in response to the 2008 financial crisis. Okay, that's good. Now, yes, I remember this. J.P. Morgan CEO Jamie Dimon said on Friday that the banking industry would not accept the Clarity Act as written, arguing that the bill allows crypto companies to pay interest on user deposits and stablecoins. The bill allows crypto companies to pay interest on user deposits and stablecoin balances. This week, lawmakers in the Senate will have the opportunity to start consolidating the versions of market structure passed by the Agricultural Committee in January and Banking Committee in May, creating legislation that some in the chamber, meaning the Senate, expect will be up for a vote by August. Okay, so the gears of legislation continue to churn. White House crypto advisor Patrick Witt said in May that officials were setting a target for the U.S. Independence Day holiday. But it was unclear whether the bill would be ready for a vote amid pushback over ethics. Okay, so U.S. Senator Kirsten Gillibrand, a Democrat from New York, she took Hillary Clinton's seat, said in May that there will be no one voting for this bill if we don't have an ethics provision. Okay, Kirsten. Lawmakers in the Banking Committee did not take up consideration of amendments that would have addressed ethics and conflicts of interest, with some Republicans saying that the issue was a matter for the full Senate. So lawmakers in the Banking Committee did not take up consideration of amendments that would have addressed ethics and conflicts of interest. So with some members, perhaps in the Banking Committee, saying that the issue is a matter for the full Senate. All right, so it seems that the majority, razor-thin majority Republicans in the Banking Committee of the Senate wanted to wait to get this out of committee and bring it over to the full Senate floor, okay, for perhaps more robust debate. on the Senate floor. So this gentleman, crypto advisor Patrick Witt, or target for Independence Day, but may be up for a vote by August. So let's see if that timeline will hold. And the article goes on to say, should a consolidated bill reach the Senate floor in a matter of weeks, the Republican-led chamber would still need some support from Democrats to meet the 60-vote requirement to pass the legislation and return it to the House and potentially the president's desk. Yes, some lawmakers, including Senator Elizabeth Warren, have called out U.S. President Donald Trump's ties to the crypto industry in debate on clarity based on his meme coin, his family's crypto business, World Liberty Financial, and other conflicts as an elected official. Okay, fair point. I think that members on the other side of the aisle might also have their fingers in the cookie jar for all things crypto, but let's see. Now, more than 1.1 million has been wagered on Polymarket on the likelihood of the law's passage this year, with the prediction market showing a 55% chance of that happening at least at last look on Monday. Okay, so the chance of the Clarity Act signed into law in 2026. Right, so Donald Trump wants to sign it into law, and the Senate wants to sign it into law, and then it has to go back to the House to be ratified and approve the updated version. So Genius Act comment period ending. And so you can see back in February, it was below, it was all the way down to 35-40% in January, February, and now it spiked up at the beginning of May, and now it's back down to 55%. Okay, so Genius Act comment period ending. On Tuesday, meaning the 2nd of June, the U.S. Treasury Department, Federal Deposit Insurance Corporation, and Financial Crimes Enforcement Network and Treasury's Office of Foreign Assets Control will close for public comments on the Genius Act, a stablecoin payment bill signed into law in July of 2025. Although at least one banking group has requested that the government agencies extend the comment period, the Tuesday deadline is expected to mark the next step of Genius implementation. According to the bill, it will go into effect 18 months after enactment or 120 days after regulators issue final rule. So the Genius Act is actually still not technically come into effect because it has to still be open for comment by some of these departments and agencies that are going to be affected or have some jurisdiction over the result of the Genius Act. So that really, yes, it was passed in July of 2025. As you saw up here, the article is focusing on not the Genius Act, but the Clarity Act. So the Clarity Act was technically shelved. It was halfway there, and it passed the House in July of 25 when the Genius Act was passed through. But the Clarity Act has been back and forth for a long while. So this is interesting stuff. Okay. So with that being said, we will come back to this wonderful update in the days and weeks ahead. Looking forward to covering this because this is for us over here really, really interesting stuff. This is, again, right where we believe rubber hits the road, is how governments, some of the biggest governments on planet Earth, are either going to be proactive when it comes to digital assets. And I know that the key issue that we've been discussing with Clarity is really the yield. Is the yield going to be something that is exclusive to banks, which is what Jamie Dimon wants, or is the yield going to be something that can extend to companies like Coinbase? So this is what Coinbase wants. So let us see with the Clarity Act. Now, in conclusion, as we wrap up today's wonderful live stream, please invite your friends to visit cryptodeposit.org. If you know any institutional folks, people that do work in banking, specifically family offices, we offer white label solutions. We consider ourselves a one-stop shop solution. We can do white glove, all of that onboarding. Just give us a buzz, as my former boss's boss used to say, the great Patrick Salerno. Okay, so let us take a break. We are going to come back with another live stream soon. I'm going to now do another video from a Bloomberg article that I found interesting, so that will be coming up in just a little while later today. So thank you everybody for your wonderful time and attention. I think we're going to wrap up our live stream at this point in time, and I just wanted to thank everybody for your consideration of cryptodeposit.org, for your consideration of introductions or sharing any of our videos, sharing our YouTube channel, recommending folks to do some not just live streams, but webinars and all these great potential podcasts. We are open for consideration. We are shortlisting folks. We have one already planned with a yet to be disclosed future partner perhaps, so looking forward to that recording. So please leave your comments. We try to respond to all the comments that we are going to be getting, your feedback, suggestions as well. Wishing you all a wonderful rest of your day, rest of your week, as we are now exiting Wednesday and then entering Thursday in this first week of June 2026. Wishing you all a great day, and see you on another video very, very soon, or another live stream in the near future. Thank you everybody, and take care.